Are you wondering if adding extra to super is worth it? In this video, we'll go through the benefits of adding to super, things you need to know about, and how making small yet smart moves now can add up to thousands of dollars in extra super, lower tax, and mean an early retirement for you. My name is Daniel Thompson. I'm a financial advisor and the founder of New Era Financial Planning. And in this video, as I mentioned, we'll go through pros and cons of adding extra to super, the things you need to think about and consider whether it's right for you, an example of the tax benefits of it, and ways that you can add extra to super without feeling too much out of your hip pocket. So jumping in, starting with the major benefits and main sort of pros of adding extra to super. The big one is the tax benefit. So superannuation is a retirement vehicle and a very tax favorable one at that. So putting money into super, the super funds, when money goes into super, the tax rate is only 15%. So super does get taxed when money goes in, but it's a flat rate of 15%. So it's usually a lot lower than our personal tax rates. Most people are paying tax a tax rate of at least 30%. So if you earn above $45,000, your tax rate will be 30% or higher. You can be 30, might be 37, even 45, depending on if you're sort of above 190,000 a year in income. That's the tax rate. Then you've got your 2% Medicare on top of that. So you're looking at sort of 32, 39, 47% in terms of what they call your marginal tax rate. So what that means is the tax bracket essentially that you're on. So any extra dollar of income you earn, whether it's pay rise, bonus, overtime, gets taxed at that rate. So that's what we look at comparing when we look at, is it worth making extra contributions to super, because your income will come down a little bit, and that's the sort of tax amount or tax rate that you will save. So the big benefit is that the tax that you'll save. So as an example, if you're earning a sort of, let's call it an average income of $90,000 a year-ish, you're on that 30% tax bracket plus 2% for Medicare, so 32% in total. Say you want to add a bit extra into super, $100 a week or a couple of $100 a fortnight. That going into super will reduce your taxable income. So that $100 a week is $5,200 a year. At 32%, it's a little under $1,700 a year, so $1,660 odd in tax savings, personal tax savings that you will make from that contribution. So $5,200 will go into super from your what they call pre-tax salary before you get paid, and that will mean you pay a little under $1,700 less in tax for that year. The super fund will get taxed on that $5,200 going in, so that 15%. So that in itself is a little under $800. So 15% of the $5,200 will get paid from the super fund to the ATO. It's nothing that you need to do, but that'll get paid that way. So overall, the net benefit is sort of $800 to $900 for that, in this example, for that contribution from a tax perspective. That's just the initial upfront benefit. Obviously, over time, the extra money going in will compound and grow further and really boost super. So the other parts of the tax benefit that a lot of people aren't as aware of are, once the money's in super, the earnings that it makes are also only taxed at 15%, and any capital gains that are sort of taxable are taxed potentially even lower, as low as 10% because of discount. So essentially it's a maximum tax rate of 15% of what the money makes in super as well. Whereas personally, if we've got money sitting in a bank account earning interest, if we've got an investment earning income, that income is added to our personal income and taxed at that marginal tax rate. So whether it's the 30 plus Medicare, 37, 45, whatever it might be. So that's the other big benefit, that there's not just the contribution tax saving, but the tax savings on the earnings and the income that the super generates, or the investment, I should say, generates inside super versus if you did the same thing outside super. The final part of the tax benefit comes at the end at retirement. And again, this is something that probably not enough people know about at the moment. you've got up to $1.9 million per person at the moment can be converted in retirement once you meet certain age and requirements to do this. You can set that up as a tax-free income stream. And again, this is per person, so you can look at 3.8 million as a couple, but 1.9 million per person through that superannuation environment can be set up essentially tax-free from an income perspective. So the amount that you draw out or take out, whether it's regular or ad hoc, is tax-free. And the income that it generates, the earnings, any capital gains and capital growth as well, is all tax-free as long as you meet those requirements. So not only is it really beneficial going in, but when it comes out, it's you essentially can set it up as a tax-free or in a tax-free environment as long as you're under that sort of cap and meet some other requirements. In terms of the downsides of adding extra to super, there's really two main ones. One is the accessibility. So this is a bit of a double-edged sword, that the lack of accessibility is a good thing in the sense that it allows the investment to grow and compound over time. With investing, time's your best friend. You want to invest early, invest often, and let it grow and compound and not withdraw it, not touch it. Super allows you to do that. The major downside, though, is apart from some very severe and serious things happening that allow you to access super, death, disablement, severe financial hardship, generally super is not accessible. So you can't put the money in there, realize you need it a year later and pull it back out. You can't, unless it's for things like as a first home super saver, I should mention, but as a general rule, the money that goes in can't be drawn back out again. So we really recommend for a lot of people making sure that this money is for the long term. It's not needed short term. Things like cash buffers are in place to cover short term expenses or things that pop up, and that this money can be invested longer term and not needed. So that's one of the big downsides, and the younger the people are, the longer that time until they can access it. So right now, the earliest that you can access super, apart from meeting one of those other sort of stringent requirements, is 60. So if you're 30 now, you've got 30 years potentially before you can even access that money. So that's something to really keep in mind. The other downside is the amount that you can put in and claim as a tax deduction. So right now, as of 2024, the current what they call contribution or concessional contribution limit is $30,000 per year. That includes what your employer puts in as well, though. So if you're earning $100,000 a year and your employer is putting the 11.5% on top of that into super, that's $11,500 a year. You then only have $18,500 extra that you can contribute into super, because you've only got that 30,000 cap, including what work put in. So 11.5 already in. You've got up to 18,500 then to play with, essentially. There are some ways to put more than that in and utilize previous years. For example, if you haven't contributed into super extra and you've got some room in previous year's caps, you can use some of that up and what they call catch up some of those contributions. I'll talk about that separately because that's its own strategy in itself. But as a general rule, you're looking at $30,000, including what you get contributed from work. And you really don't want to go over that, because then it really does have some tax consequences and pretty major ones if you do go over that threshold. So in terms of, I suppose firstly, current contribution amounts and the best ways to contribute. So right now, what they call the super guarantee contribution amount, you might have heard that term, or SGC for short, is 11.5%. That will go up to 12% from July 2025 and stay there based on current legislation. We find, research I should say, has found quite a bit around the world, not just in Australia, that an ideal contribution rate over your working career to be able to replace your income in retirement is about 15%. So we work on that. We like to use sort of science-backed data to form a lot of our sort of philosophy and strategies. So this is where the retirement system, it's not perfect, but it is a really good one in the sense that right now there's 11.5. In less than a year's time, you're going to have 12% of your income going into super regularly from your employer. what we generally like to do is gradually, for most people, increase this up to 15% of their income for as long as possible, because that means that the super balance grows further and further, and you get more and more of a chance of replacing your income in retirement. So a practical example of this is to right now, all across the country, things are a lot tighter financially than they were a year and definitely 2 years ago. So obviously inflation and the cost of living, things have gone up quite markedly in the last couple of years. Interest rates have shot up over the last 2 years. So super might naturally fall down the list, and there might, well, generally there's not as much disposable income or income for people to add extra to super. So a way to do this is adding either 0.5% or to 1%. So a small amount every time you get a pay rise or each year. So if you get a 2 or 3 or even a 5% pay rise, you just take 0.5% of that or 1% of the new income and increase the amount of your super contribution by that amount. So it's not a quick fix. We tend to find it takes anywhere from 2 to 5 years to get from 12 to or 11.5 to 15%. But over time, it's a way to increase the amount going into super without feeling the pinch, basically, because you're doing it out of future pay rises. The easiest and simplest way is to do what's called a salary sacrifice contribution. You might have heard that term as well. It's basically through the employer, through payroll, they will just increase the amount. It's either using a form or even just an email saying how much you want to increase. So each year of pay rise, we generally recommend saying, let's increase it by another 0.5% or 1% on what it was, so that you're gradually going from 11.5 to 12 to 13 up towards 15%, and potentially they're maxing out for a little while everything else non-super related gets met financially, and potentially over time or closer to retirement increasing further. That's what we find a really simple and effective way to gradually increase your super contributions without feeling the pinch of saying, let's add another sort of $500 a month or $100 a week, which might be a bit tight at the moment. So the other things to really consider, and sort of wrapping up this, there are a lot of benefits with adding extra to super. The other things to consider though are things like any other financial requirements that you have or goals. So home loan, any other loans. If there's a car loan, a personal loan or credit cards, generally they're better to pay off before you start adding extra to super. Having, as I mentioned earlier, a cash buffer or cash reserve, we like to have that in place because of that lack of accessibility with super. Also things like, this comes back to the accessibility, when you want to sort of access the money and have that, well, whether you call it retirement or financial independence, we work with a lot of people in their 20s through to 50s. So the younger, generally when you're younger, you want to aim to sort of have that financial independence at 50, not so much 60 or 65. So that can then mean that there's a balance between putting more in or when you start putting money into super versus setting yourself up outside super. If you're 50 now, for example, or 55, and you're more than comfortable working for another 10 or 15 years, it might be that super you go all in on, and that's your retirement vehicle because it's not too far away to access it. It's amazing from a tax point of view, and you can get some really good growth and returns when set up properly. So they're the things to really consider and balance about when to start / increase investing into super, and also how much to be putting in. I hope that helps. If anyone wants to go through this, it does take some calculation and a bit of working on how much you're able to put in, how much you should, and those other sort of things that you want to work on. Feel free to reach out or drop a comment in and we can have a quick chat. Otherwise, I will see you in the next video.